Hey guys, today I'm going to be talking about exchange rates. All right, let's dive right into nominal exchange rates. Well, what is a nominal exchange rate? A nominal exchange rate is the price of one country's currency in terms of another currency. So how does this apply to the real world? Well, if you want to buy a good or service from another country, you're usually required to convert your currency into theirs in order to complete the transaction. So I like to think of this as vacations. A Canadian going to the United States, and the United States transacts in USD, and we have Canadian dollars. So we'll need to swap our currency into USD in order to make purchases while we're in the United States. And as globalization increases, exchange rates are going to play an ever increasing role in our lives. So, multilateral exchange rates, what are they? Well, the value of a country's currency in terms of several other countries' currencies is what a multilateral exchange rate is. Now, let's go into currency appreciation and depreciation. How does a currency appreciate and how does a currency depreciate? Well, appreciation occurs when a country's exchange rate value increases. When this occurs, it can be harder to sell goods or assets in that country. And that's because the country's goods are now more expensive relative to others. And the opposite happens with depreciation, which occurs when the value of a country's exchange rate decreases. And this can mean that a country may have an easier time selling goods because your country's goods are now cheaper relative to others. All right, real exchange rates. What is a real exchange rate? Well, this is going to be the amount of foreign goods a person obtains in exchange for one domestic good. How are real exchange rates calculated? Well, these are calculated using price indexes such as the CPI and the GDP deflator. And what is the formula? How do we determine this? Well, that's going to be the real exchange rate would be equal to the nominal exchange rate multiplied by the price index of the domestic over the price index of the foreign. All right, let's go into supply and demand. Under a flexible exchange rate, the forces of supply and demand directly influence the exchange rate. When demand for a currency exceeds supply, the currency appreciates. When supply exceeds demand, the currency depreciates. So what are the sources of demand for Canadian currency? Well, there's three main ones: the foreign demand for Canadian goods and services, foreign demand for Canadian physical assets such as companies and land, and then foreign demand for paper assets such as bonds and T-bills. As demand for these things increase, the demand for Canadian currency increases as well. For sources of supply for Canadian currency, this is going to be the Canadian demand for foreign goods and services, physical assets, and paper assets. So the lower the demand for foreign goods and assets, the lower the supply of Canadian dollars on the FX market. So let's go on to supply and demand shifts. So the simplest way to think about it is going to be anything that makes Canadian goods, services, or assets more attractive relative to foreign ones will cause the demand curve to shift right and the supply curve to shift left. So some examples of shifters are going to be the ratio of Canadian to foreign prices. And this matters since the demand and supply of Canadian dollars related to goods, services, and assets is going to depend on the real exchange rate. For a given nominal exchange rate, the lower the Canadian prices are relative to the foreign, the lower the real exchange rate will be. The next one is going to be the interest rate spread, which is the difference between Canadian interest rates and foreign rates. And this makes Canadian assets relatively more attractive to both Canadians and foreigners. This means that demand for Canadian dollar will be higher and shift the demand curve right. And then we have the demand for Canadian goods. And when this increases, it causes a shift to the right because more people will demand Canadian dollars. So let's go into an example here. On the left side, we have the nominal exchange rate of the Canadian dollar. And on the bottom here, we have the quantity. So here we have the demand of the currency as well as the supply. And then we have an equilibrium nominal exchange rate. So what happens when we get a shift of higher demand towards Canadian goods, services, and assets? Well, like I said earlier, if more people are demanding Canadian goods, services, and assets, they'll have to convert their currency, and there'll be a demand on Canadian currency. So as we can see, we'll get a demand shift right, and then we'll get a supply shift left. And so this will cause an equilibrium exchange rate to increase. as we can see here. So once again, the demand will move to the right and the supply will move to the left when we have a shift of higher demand towards Canadians, goods, services, and assets. So for the sources for this presentation, I used the textbook, the professor's notes, as well as a Khan Academy lecture. Thank you so much for watching. I really appreciate your time.